Hi, welcome to my YouTube channel. And today we are going to discuss about the basic financial ratios. We are going to discuss about the markup, margin, the rate of stock turnover or ROST, the working capital, stroke the current ratio, and finally the return on capital. And we are also going to see some examples where we can apply them. So very first, what is markup? Markup is given by the ratio of the gross profit over the cost of sales. We can express it as a percentage by multiplying it by 100%. Margin is given by the ratio of the gross profit over the net sales. Net sales, again, we can express this as a percentage by multiplying it by 100%. Coming to the rate of stock turnover or ROST, rate of stock turnover is given by the cost of sales divided by the average stock, average stock. And how do we get the average stock? Average stock is given by the opening stock plus the closing stock. We are dividing by 2 to get the average, and that is how we get our average stock. And the cost of sales, I believe you know how to get from the previous videos. Then working capital ratio or the current ratio is given by the current assets divided by current liabilities. Return on capital is the ratio of the gross profit over the capital invested in the business, the capital invested. And if you want to express this as a percentage, you'll multiply it by 100%. Now, basically, these are some of the ratios which we are going to discuss. I want us to move to an example and see how we can apply them. Now, we have this worked example on financial ratios. The following information relates to BT retailers for the month of July 2015. We have the sales 50,000. We have the cost of sales as 40,000. We have the average stock as 20,000. Expenses is 5% of sales. Then they want us to calculate the markup, margin, total expenses, net profit, and the rate of stock turnover. Now, this one is easier because it is not complicated. Now, I want you to see how we are getting the markup. From the previous slide, we said markup is given by the gross profit over the cost of sales, Now, maybe as a percentage, you can multiply by 100%. Now, in this case, we don't have the gross profit, but we have the sales and the cost of sales. And therefore, our gross profit can be gotten by gross profit is equal to the sales minus the cost of sales. And that one will be 50,000 minus 40,000 to get 10,000 shillings. And therefore, this is our gross profit. So if we want the markup, it will be our gross profit 10,000 over the cost of sales 40,000 times 100%, and we'll have it as 25%. So 25% is our markup. So this is Roman 1. Roman 2, we are talking about the margin. The margin is the ratio of the gross profit over the net sales. Now, what is our gross profit? Still, we have calculated it here. It is 10,000. We have it 10,000 over the net sales, which here we are going to take as 50,000 times 100%. Now, we are taking sales as the net sales because we don't have the sales returns or the returns outwards. So once it is not provided, we are going to take the sales as our net sales. Now, if you simplify this, you will find that our margin is 20%. And this is our margin. This was our markup. Now, moving to part month 3. Month 3, they want the total expenses. The total expenses. How do we get the total expenses? They said that total expenses is the 5% of the sales. And what is our sales? Our sales is, we have 5 over 100 times the sales, which is 50,000. Then from there, we'll have our expenses as 2,500 shillings. That is our expense. Roman 4, we have the net profit. Net profit. Net profit. The net profit is given by the gross profit. Gross profit minus gross profit plus any other income which we are not given minus the total expenses. Now the gross profit is 10,000 minus total expenses. We have it as 2,500. We'll have our net profit as 7,500 shillings. That is our net profit. And finally, let's discuss about the rate of stock turnover. Rate of stock turnover, which is, we said previously, is given by the cost of sales divided by the average stock. Now, all this we have the cost of sales as 40,000, and we have the average stock we have been given as 20,000. If you divide this, you'll get 2 times. So to mean that during that accounting period, the stock, BP retailers restocked 2 times, or the stock changed 2 times. Now, that is our first example. I want to take you to another example. I want to believe you are following. If you have any question, you can contact me. You can ask through the comment. Let's look at this question again. Now, sometimes if you want to also assess yourself, you can post the video, then you do it, then you compare your findings with my findings. But let us see how to handle this together. Now, let's have the question. The following information relates to Siku retailers for the month of July 2015. We have the sales 750,000, opening stock 200,000, purchases 300,000, closing stock 100,000, sales returns we have 50,000, then expenses 5% of the net sales, not of sales but of the net sales. Then they want us to calculate the gross profit. Now, what do you know about the gross profit? We have got sales and opening stock, purchases, closing stock. So we can have the gross profit. Gross profit, this is Roman 1, is given by the net sales minus the cost of sales. Now, what is our net sales? Our net sales is given by the sales minus sales returns, which is equal to 750, our sales 750,000 minus the sales returns 50,000. We are getting our net sales as 700,000. That is our net sales. And what about the cost of sales? The cost of sales is given by the opening stock plus the purchases minus the purchases returns minus the closing stock. Purchases returns we are not given. So what is our opening stock? Our opening stock is 200,000 plus purchases we have there as 300,000 300,000 minus the closing stock we have as 100,000. 100,000. What do we get? We have 400,000 as our cost of sales, and therefore the difference between the net sales and the cost of sales give us the gross profit of 300,000. So this business realized a gross profit of 300,000. Gross profit of 300,000. Now, Roman 2, what is the markup? The markup we said from the previous one, it is the gross profit, the ratio of the gross profit over the cost of sales. Cost of sales, which is, okay, we can multiply this by 100. We have the gross profit as 300,000 over the cost of sales, we have it as 400,000 times the 100%. And what do we have here? We have our markup percent as 75%. That is our markup. What of margin? Margin is given by the gross profit over the net sales times 100%, of which our gross profit is 300,000 over the net sales we have 700,000 times 100%. You work out that and you get your answer. Roman 4, total expenses. Total expenses. They said that total expenses is the 5% of the net sales. Remember, we are not going to use the 750 of sales. Net sales we have calculated here to be 700. So it will be 5 over 100 times 700,000. Then from here you will have your total expenses. If we come to Roman 5, the net profit is given by the gross profit minus total expenses. Now you have your gross profit as 300,000. It will be 300,000 minus the total expenses above here. The answer which you obtain there, you subtract, then you get your answer. And finally, let's talk about the rate of stock turnover, ROST. ROST is given by the cost of sales. Cost of sales over the average stock. Average stock. Cost of sales we have as 400,000. 400,000 over, what do we have here? Over the average stock. Average stock, we have the opening stock, which is opening stock, we have 200,000 plus the closing stock, which is 100,000. We are dividing this by 2. So we'll have 400,000 divided by 150,000, and you'll get your answer there, and it must be times. Now, that's how we can get, that's how we can apply the basic financial ratios. I know there are some, but in any case, you have got any question or any concern or any input, you can always contact me by commenting. Thank you for watching my video, and I want to wish you well and keep on checking for more videos soon. Thank you.